Hello and welcome to this video. In this video, I am going to define very precisely the chapter number 1 of the corporate finance. Imagine that you were to start your own business. No matter what type you started, you would have to answer following 3 questions in some form or another. Number first is, what long-term investment should you take on? This is what lines of business will you be in and what sort of buildings, machinery and equipment will you need. Number second question is that where will you get the long-term financing to pay for your investment? Will you bring in other owners or will you borrow the money? How will you manage your everyday financial activities such as collecting from customers and paying suppliers? Corporate finance, broadly speaking, is the study of ways to answer these 3 questions. Number first question concerns the firm's long-term investments. The process of planning and managing a firm's long-term investments is called capital budgeting. In capital budgeting, the financial manager tries to identify investment opportunities that are worth more to the firm than they cost to acquire. Evaluating the size, timing, and risk of future cash flows is the sense of capital budgeting. The second question for the financial manager concerns ways in which the firm obtains and manages the long-term financing it needs to support its long-term investments. The firm's capital structure or financial structure is the specific mixture of long-term debt and equity the firm uses to finance its operations. The financial manager has 2 concerns. First, how much should the firm borrow? Second, what are the least expensive sources of funds for the firm? The third question concerns working capital management. The term working capital refers to a firm's short-term assets such as inventory and its short-term liabilities such as money owed to suppliers. Managing the firm's working capital is a day-to-day activity that ensures that firm has sufficient resources to continue its operations and avoid costly interruption. And after this, the forms of business organization. Number first is the sole proprietorship. A sole proprietorship is a business owned by one person. This is the simplest type of business to start and is the least regulated form of organization. Number second is the partnership. A partnership is similar to a proprietorship except that there are 2 or more owners or partners. Number third form of business organization is corporation. The financial manager acts in the shareholders' best interest by making decisions that increase the value of the stock. The appropriate goal for the financial manager can thus be stated quite easily. The goal of financial management is to maximize the current value per share of the existing stock. The goal of maximizing the value of a stock avoids the problem associated with other different goals. There is no ambiguity in the criterion, and there is no short-run versus long-run issue. You know that one of the advantages of the corporate form of business is that management is separate from its owners or shareholders. That's why there is the agency relationship between the stockholders and management. Such a relationship exists whenever someone, the principal, hires another, the agent, to represent his or her interests. You know that the advantages of the corporate firm are enhanced by the existing of financial markets. Financial markets play an extremely important role in corporate finance because it provides the liquidity. Financial markets can be primary versus secondary markets. The term primary markets refers to the original sale of securities by governments and corporations, whereas the secondary market are those in which these securities are bought and sold after the original sale. That's the short overview of the chapter number 1